trace it down to a particular cow from a particular farm. Not always, but as far as I understand, it happens. So if something bad happens, you can trace it back to a particular farm. And you can fix the problem. You can shut down the farm quickly, right? This would be like original mortgages. A much better way to sell meat is to sell it as the ground meat, right? When you mix everything up. So it's still meat, right? You can still somehow price it. It might come from a good cow. It might get from a diseased cow, right? You can still price and you can sell it. So do we need ground beef? Well, yes, because in terms of the technological project, it's much kind of like easier to produce, right? However, if you get poisoned from this thing, that's it. You cannot trace it back to a particular butcher. You cannot eliminate the problem. So these are mortgage-based securities. So the price is what the market price is. But if there is one bacteria and you get severely sick, right, you can shut down the entire marketplace, right? There won't be no meat anymore, right? But you cannot trace it back to a particular cow, right? You cannot figure out that, this household defaulted on their mortgages and we need to do, or this segment of the market, this segment of the market is kind of like underperforming and we need to fix it and it will kind of like prop up the value of all the mortgage-based securities. So this is the example. So it's complicated. You look in there and you don't know what you are getting. Also, what I call the second myth, that the complex financial models are wrong. Well, they're not entirely wrong. They're just sometimes they kind of misfire, right? And here I'm taking a defensive stand because I'm a finance professor. That's what we teach those models, right? So I feel a little bit embarrassed. So they do misfire. This is not the first time it's happening, right? If you look back at the 1998 crisis, right, and the fall of the largest hedge funds, if you remember, long-term capital management, right? And the long-term capital management was set up and run by the very smartest people in finance. They were smart by finance professors, and two of them had Nobel Prize, right? And it still sank. So it's not that the finance models are wrong, it's just sometimes accidents happen. If you have a spacecraft shuttle explosion, and all astronauts die, you don't say that engineering is wrong, right? Accidents happen. It's just the world is so interlinked that one small accident can lead to more and more accidents. So here the problem was actually what I call two L's. Two L's. Leverage and liquidity. So by separating those, kind of like slicing those mortgages, repackaging them, and selling them as the chunk of ground beef, it created liquidity, which is a good thing, right? Because it's easier to transport the ground beef than the, beef in separate pieces. So that was a good thing. But when you have too much liquidity, when the markets collapse, all the markets interlink. So if the market collapses in New York City, it's kind of like adversely affects all the stock markets around the world. But yet another big problem was leverage, right? And again, leverage means that you finance your investments by borrowing money. You spend more than what you have. So, so investors all over the world could invest in the securities thinking they were safe, and because they could leverage, right, they could borrow, that they spend more than what they had. And again, that was a beautiful thing as long as the underlying price of these assets, the value of the houses, kept increasing. So when you finance your investment with a lot of borrowed money, right, you generate, you pretty much multiply your return by a factor of your leverage, right? So instead of earning 20% return, you can earn 200% return, right? But you earn that 200% return when the initial return 20% was positive. When the return is negative, actually, you kind of like have to absorb much larger losses. And that's what actually kind of like scares people and policy makers right now, that how much people could borrow to buy those securities, right? And again, it was the kind of like era of low interest rates, so people could borrow a lot and take larger and larger risks. And that scares the policymakers, because if you connect the Great Depression, right, the stock market crash in 1929 and the subsequent Great Depression in the United States. And actually, as far as like what I know, what I've read, that the Great Depression was even more depressing in Canada than in the United States back that time. That was also caused by leverage. There was a stock market, tremendous stock market boom in the US back that time, and people could borrow more and more money to buy more and more securities. So this is actually what links the current crisis to Great Depression. So we try to, I mean, the world will try to avoid it the best, not to have it as bad, but you know, kind of like there is no guarantee. So things are fine as long as the house prices have been rapidly appreciating. So the subprime borrowers could borrow against their home value through home equity loans, or they, in case they had to settle their debt, they could just sell their houses. So as long as the prices, as long as the bubble was growing, you know, everyone was happy and many people were making really good money. But once it's burst, you know, all these profits suddenly turn into losses. And now we're in a very unpleasant situation, you know, all over the world, when the value of the houses might get lower than the amount of what people owe in their mortgages. This is really kind of like a bad situation. And again, it's not as bad in North America where the mortgages are not callable. But in some parts of the world, they are callable. In a sense, if the value of your house, the market price of your house, goes lower than the amount of money you owe, the bank calls you and says, now you have to repay all your money. Right? So imagine a 30-year mortgage, you get a call that you have to repay it within 1 year. Right? I mean, that creates defaults. So due to this kind of policies, the interest rates were low, so it increased, people were increasing the borrowing. And you know, the house prices, due to various reasons, the house prices became to fall in mid-2006, and the interest rates began to rise, right? And it was kind of like an unfortunate thing. And the house prices started falling because there was just too much inventory. There was just overbuilding. If you look at the markets such as Florida, Arizona, Las Vegas, right? There was just too much construction going on, too much speculation going on, a very big bubble, right? So when you have too much inventories and the demand for houses goes down due to various reasons, for example, the slightly higher interest rates, then all the developing companies, they got stuck with all those houses, right? Obviously, the house prices started going down, right? But once the house prices start going down, you know, you cannot sustain this bubble. It has to burst one way or another. So and this is just the graph of the percentage change in the single-family homes, top 20 metro areas in the United States. So it reached its peak around 2005, right? And starting from 2005, it started declining, right? And once the underlying starts declining, the price of those securities sold on secondary market started declining, and the investors started, you know, questioning the value of those securities, the riskiness of those securities. They couldn't guarantee, you know, like perpetually like plus 3%. So that's when kind of like the value of the houses started going down, the value of the securities started going down, and the panic started happening. So the panic started happening. I mean, it started happening among investors. Also started happening among banks, and I'll talk a little bit about banks soon. So the past due rate for outstanding subprime mortgages rose significantly. It reached its peak. The rate of defaults reached its peak around 2007, especially in adjustable rate mortgages, right? So it made a lot of difference whether it was the fixed rate or the adjustable rate. And people with lower credit ratings and people with lower incomes, actually, they were like pushed by mortgage brokers to get mortgages with adjustable rates, right? And they were made believe that the new century of low interest rates will stay forever, right? So there was also kind of like another like party to blame would be those mortgage brokers, right? So they had no responsibility in case a family defaults on its mortgage, right? So they were just overall trying to push investors into buying more and more homes. And they're offering them adjustable rates, right? And the adjustable rates are fine as long as the interest rates are low. Once interest rates start picking